Good morning, and thank you, Mark, and thanks all for joining. This has been quite an extraordinary time for all of us, and you know, it goes without saying there's been some terrible things happening as we've lost a lot of lives and livelihoods, and now we're going through fears of new waves as the virus is re-emerging or emerging in some places, and now we're having increased cases reported in places like Brazil and other areas around the world, Latin America and the Middle East and the like. So we're going to go through a period that's going to be very, as Nancy said a couple weeks ago, very wavy. We're not as concerned that there's going to be another shutdown, although there'll be limitations being put on the system. But when we think about what's gone on over the last several months and where we're going ahead, this is the first global pandemic that most of us have experienced, and it's caught even the best investors offsides. And we think there's a lot of things that people misunderstand or underestimate. And the three big ones are the difference between a pandemic recession and a typical economic recession, the impact of the policy response, and the digital transformation that's occurring. And some of these seem obvious that they shouldn't be misunderstood or underappreciated, but we'll try and cover a couple areas where they are. So let's go to the next slide, Mark. What's different about a pandemic recession versus an economic recession is, beside from the obvious cause, is the severity and the speed that it happens. If you think back to the 2008 crisis, it took about 22 months to hit the peak of unemployment, where it took us about 3 months to reach the peak unemployment in the US. And I'm showing you what the U3 and U6 numbers for unemployment are. The U3 is the reported one. U6 brings in people who are working part-time for economic reasons, as well as those who are discouraged and just quit looking for work. And the severity of this is really impressive when you think how much higher it is than the previous in the 2008 to 2010 period. If we jump to the next slide, Mark, one of the important elements, and this is one of the things that concerns us, is long-term economic scarring. And one of the things that I'll show you here is the gold bar is 2010, which was the peak, and the blue bar is May of this year. And what you see in the degree of unemployment, and from left to right, it's no high school degree, a high school degree, some college, or a college degree and higher. And in each of those, the unemployment levels are significantly higher. And when you follow two of these crises in less than a 12-year period, there are segments of the population that are going to be caught in periods where they're never going to achieve peak earnings, or they'll become so discouraged that it'll push them aside. And for those of us who were around in the early 80s, we had a period like this coming out of the 70s into early 80s where we lost segments of the population who never became productive members of society or achieved at certainly subpar levels of economic returns. And if you could go to the next slide, Mark. What you can see, and this is a study done, it's actually Bureau of Labor Statistics shows as of last year, what the weekly earnings were based on degrees. And it's interesting when you look at the earnings relative to the employment rates, and these are median averages, that there's so many people living really at poverty levels, and that $600 a week that the US has put in addition to the typical unemployment is why there's so much discussion around whether they should continue that or not. Is it hurting people going back to work or not? The reality is that when you look at these numbers, we need to do a better job in terms of closing the skills gap so that we don't have to subsidize workers the way that they will. And we have to figure out a way to get our educational system and our businesses and government to think differently about the educational aspects of it, because the gap's too great. So if you go to the next slide, Mark. I want to shift to the pandemic recession from a different perspective now and look at it from the rebound that's happened. And this is showing PMIs, both manufacturing and non-manufacturing for the US and for Europe. And when you look at the sharp return from April to June, April being the gold and June being the blue bars, we're getting close to, but not quite at, expansionary numbers across the board. The last one on the far right is the global G4, which includes the US, UK, the EU, and Japan. And the rebound is really staggering when you think about how sharp some of the rebound has been. But I would say what's missing in this and what's understated is the problems in the service sector that continue, and that area is lagging a bit. But we are seeing quite a rebound here, which is very different than past cycles to have it happen this fast. And I could show you a series, and I will show you a series of reports. So if you go to the next one, Mark. This next slide shows the National Association of Home Builders and the Home Building Survey, and look at the rebound from the low, how sharp the decline was, and you're starting to see the rebound. This is against a very high unemployment level, but I could show you similar charts for whether it's retail sales, whether it's the stock market looks the same way. There are a whole number of things that are showing these types of improvements. Apple Mobility shows it. Gasoline miles driven in the US, actually, it's a fascinating number, went from 5.4 million barrels a day to May and has rebounded to 7.6 million barrels in June. And that's still 2 million barrels a day lower than it was last year. So you're seeing this rebound, and think about it in the perspective of how little of the economy is still open. And nobody really knows for sure, but people are estimating that it's between 30 and 40% open right now. And we're seeing this kind of move back. So it's a very different type of economic cycle and economic recovery. And just to put it in perspective relative to the stock market, we dropped 34% in 5 weeks and rebounded about 40% in 11 weeks. These are unprecedented moves. So it's easy for people to be caught off sides in this rally. So if we jump to the next slide, Mark. This is general business conditions using the Empire Manufacturing Survey for New York, which has been locked down pretty much. And look at the bottom line is the blue line, which is the current of what happened, and comparing it to 08 recession and others. And it gives you a sense of the severity of the decline, but how fast the snapback has been relative to the 08 period. So this is very different period. So this is easy to see why people would be kind of uneasy about the moves and uncertain about how to invest appropriately in this environment. So we go to the next slide, Mark. I want to shift to the second area that I think I think the first things we covered, it's easy to misunderstand because it's so new. I think what's underappreciated is the policy response. And when we think about the policy response, we think about it, and this chart shows you the fiscal and monetary response around the globe, and starting with the US, the Eurozone, Japan. And when you think how much money we're throwing at the problem, and a lot of this has a lag effect, particularly on fiscal policy, it takes between 12 and 18 months to see the effects of fiscal stimulus monetary stimulus hitting the system. I'm sorry, fiscal stimulus can be more immediate if it gets out in the right hands and is allocated the right way. But one of the key elements that we think is not fully appreciated goes back to March. And the weekend before the Fed announcement, or the couple days before the Fed announcement on March 23rd of QE4, 2 of the leading money market fund sponsors in the US had to inject $2.6 billion of liquidity into their funds. And if you go back to the 08 crisis, one of the big elements that created a problem for us back then was when GE couldn't finance their commercial paper, and the money market funds were the big vehicle for that. So what the Fed reaction on the 23rd was in part due to the lack of liquidity in the system and the misfunctioning of the system. When you look forward, though, what's occurred since that time is they put some stability into the capital markets. But one of the things that we think is really underappreciated is by putting a floor, in a sense, on the bonds and carrying companies through this period, they've actually put a base on equities. And the reason for that is with equities, you have the obligations of the company, including the debt obligations. And by creating a stimulus and allowing the companies that were on the brink to go under only because of the pandemic, not because of structural problems that they had previously, but because of the short-term supply shock or revenue shock, they've actually allowed the equity markets to get moved up. And we think that's one of the things that's not fully appreciated is the Fed put as it carries over into equities And it's part of the reason we think explains some of the rebound there. So we think that equities have a better base than they had before, but there's a big diversion in the equity markets that we think is going to continue. It's been going on for a long time. It will continue. And we think there's going to be a diversion between the haves and have-nots ongoing. And there are businesses that are, the zombie businesses have been carried, but they're going to go under at some point. They're just delaying the inevitable. But there are a large segment of the economy that is being propped up during this period where they would have been okay prior, and now can continue to do business. As we reemerge, those businesses should come off, taking a lot of pressure off the system. So we think that's a key element that's not fully appreciated. Now we'll go to the next area, Mark. And one of the key elements of what's going on, and this is a slide I've shown before, but the digital transformation, this is from Steve Case's book, The Third Wave. And we've been in the third wave for some time. And for those who've heard me speak before, I said that 5G is an enabling technology that allows the Internet of Everything to start moving and become realized. What the pandemic's done is it's accelerated the digital adoption and digital transformation. And it's interesting, in the FT today, there's an article on Italy and some of the changes and how this digital transformation is pulling some of the black market activities into the regular economy because people are doing more online. And there's a quote from Vittorio Caleo, who is the former CEO of Vodafone and is now leading the task force on the European reopening. And he had a statement in the article that says, the virus has allowed the country to achieve in the same amount of progress for digital adoption in 2 months that would have normally taken 5 years. And we think that's something that's fully underappreciated still too, that there's so much moving there. We see it and we're living it, but to step back and look at it at a bigger picture, it gets a little bit hard. So if you go to the next slide, Mark. I think the key themes that are coming out of this digital transformation that are really investable areas, not just for now, but for the long term, are these: the acceleration of public cloud adoption, e-commerce, cybersecurity, contactless payments. We heard from one of our clients in Asia that they had friends who were washing currencies so that they wouldn't contract the virus. So that's moving things, literally washing their money so that they wouldn't get the virus. You're seeing robotics pick up at a much faster rate. And the advances in healthcare are one of the big things that's one of our gets us most excited, because they're using artificial intelligence to do tests that would have taken years and condensing the time. You're also seeing it in digital entertainment and sports and esports, which is something you guys are going to talk about more later. And this rapid adoption of AI and 3D printing and blockchain technologies, things are being pulled forward at a much faster rate, and companies are being forced to look at how they use technology to deal with the decline in revenues or the revenue hits that they've taken. So this is an area that continues to excite us, but we don't think it's a short-term thing. We think this is a permanent thing, and that element is underappreciated. And you see it in the S&P. The 5 largest stocks in the S&P have a weighting now that's 23% of the S&P, and that's equivalent to 350 bottom stocks in the S&P in terms of market cap. The 3 largest stocks in the S&P in market cap, their market cap is equivalent to the GDP of Germany, which is the 4th largest economy in the world. So this is not a short-term thing, and you can argue that they're highly valued, but we think that the valuations are accounting for the current needs, but also maybe looking a lot more at the future needs than a lot of people are giving them credit for. So Mark, if you jump to the next slide, I just want to touch on the concerns and what excites us. Longer term, we're very concerned about the inequality issues, and we think the policy response right now is going to exacerbate that. So that's going to create some unintended consequences that we have to address, and we have to do it by focusing on education and the skills gap around the world. US-China relations, when the 2 biggest economies are going against each other, is obviously a big concern. But really, the longer-term economic scarring is one. And the other one that's a big one around the world is, are we going to get the investment returns on the fiscal stimulus that's being provided, or is it going to be wasted like it has been in so many times in the past? And the other is, do we pull the punch bowl too soon and end the party before we've done it? When we did it in the 1930s in the US, it killed the return of the rebound. When you saw it in Europe, when they started to implement more austerity programs in the early 2012 period, that actually countered the monetary stimulus that was being put forth. So that remains a big concern. And the other one is just a lack of a plan to address long-term issues. What excites us, obviously, is the digital transformation, the scientific advances, but I want to touch on this cash on the sidelines and some contrarian views. So Ed Hyman is one of the best-known strategists, works for Evercore ISI, had a note out yesterday. And while the S&P was down, he wanted to give a contrarian note. A record percentage of investors believe stocks are overvalued. Investors are sitting on the sidelines with a record pile of cash, which is estimated to be $4 trillion in US money market funds and about $2.5 trillion in private equity. In the last week, investors have pulled $6 billion out of equities and put $18 billion into bonds. And the hedge fund survey that ISI does showed that people are in a negative to neutral level. And when I look at the AAII survey for bullish and bearish sentiment last Thursday night, it showed that the bearish sentiment was up around 40, which is usually averages about 31. And the bullish sentiment is around 29. So if you're a contrarian, maybe the markets aren't as bad off as everyone thinks. We also like the lack of enthusiasm for public equities because it means that we're not in a euphoric state, which leads to a bubble. And we think there is a real opportunity for governments to be build a more inclusive, sustainable, and equal growth rate, which is necessary for the future here. So Mark, I have one more slide, and just as a view, we think this recession has a very different character, which requires us to think differently. We think that people are underestimating the amount of support that central banks around the world are doing. If we're doing 40% of GDP globally for a problem that the IMF says we're going to have a 6% decline in GDP, there's a lot.
Sorry, Stephen, keep going. I just muted you mid-sentence.
That's okay. That's Mark's view of a hook. So I was ending there anyway. We think this digital transformation is one that really bears watching and should not be underestimated. So thank you, Mark.
So thank you, Stephen. I literally did not mean to hook you, but I wanted to keep the conversation going. First, any quick questions on what you heard or comments? Again, if you're new to this, these are interactive.
Stephen, I'll jump out and ask you a question. I mean, just in terms of, debt levels around the world and how much, debt is kind of coming into the forefront here for countries like the United States and, in response to COVID-19 and what's going on in this pandemic. And then in addition to that, inflation. There's two topics, debt, global debt, and then inflation. What are your thoughts there? Anything to be worried about?
Inflation. We're in the deflationary camp. We think that the pressures tend to be more deflationary than inflationary. Although with reshoring and other things going on, we think there'll be short-term pockets of inflation that are more transitory than sustainable. And with the debt levels and deficits for the U.S., they're a concern, obviously, but they're not the primary concern. The primary concern is getting the economy back on track. So they're necessary evils right now. But that's why you need a long-term plan. And without that, they will become a big problem. For the US, as long as we retain the reserve currency status, it's less of a problem. And we are very confident that governments are going to be forced to manage to keep rates low. And if they need to, they will revert to what they did in the post-World War II period, which is put interest rate caps on to manage the debt levels and interest rate levels. It's been done before and it can be done again. The Fed's looked at it. Powell says they're not rushing to that. But when push comes to shove, they've already told you they're going to pull out all the stops. So we think it's something that needs to be addressed in the long term, but it's fully appropriate in the short term. And we would argue that Europe made a huge mistake for the last decade by focusing too much on austerity and not dealing with the real issues. And that's one of the other things that I think people should be aware of, is that Merkel and Macron, when they put together that $500 billion fiscal support program and are getting that pushed through, we think that's a big sign of a transition, and actually will take a lot of pressure off the European system if they follow through on what they're doing there. So at a time, there's a time to worry about debt and deficits. We don't think this is it right now.